Hi, I'm Claire Howarth from Oxford Economics. Can I start by welcoming you all and thanking you for joining this Oxford Economics webinar today. Gabriel Stein is going to talk about Asia-Pacific bonds and their implication for asset allocations in 2015. Before we get started, just a few housekeeping points. Gabriel will talk for about 20 minutes and we'll then be taking questions. If you would like to ask a question, there should be a drop-down box at the top of your screen. Please use the chat icon that's in the drop-down at the top of your screen and send a private message to host Adrienne. This can be done throughout the presentation. Please, can you remember to stay on mute so there's no disruption during the webinar? That's all from me. I'm now going to pass over to Gabriel.
Thank you very much, Claire, and thank you very much, ladies and gentlemen, for listening in, whether it be morning or afternoon where you are right now. I apologize from the start because I've managed to catch a cold, so if suddenly I'm overcome with coughing, that may not only sound disturbing, but also add some time to the webinar, which otherwise I would hope to avoid. So as Claire said, I'm going to talk a little bit about bonds in the Asia-Pacific region and begin with and perhaps concentrate on why these are behaving in what seems to be, intuitively speaking, a strange fashion. Let me start by saying that we have now, for much of the past year or so, among our downside scenarios to our main forecast, had one scenario which has been entitled variously risk off or capital flight from emerging markets. And what this really has been about is that for whatever reason, investors looking for yield would shift to safety and perhaps more attractive assets above all in the United States, and that this would have a negative impact primarily on assets in emerging markets, including the Asia-Pacific region. Well, if we look at what's happened, and I have simply as a convenient starting point, picked July of 2014, which is when oil prices began to fall. Well, over the past 7 or 8 months, we have seen currencies and shares weakening in most Asia-Pacific countries, as in some other emerging markets as well. That is what we would have expected. The improved outlook for the United States and to a lesser extent the United Kingdom, coupled with the Bank of Japan's expanded quantitative and qualitative easing, has increased the attraction of advanced economy assets. However, rather strangely, bond markets have done well in the APAC region. Now, there are a number of reasons for this. Partly because of lower oil prices, and partly also therefore, as a result thereof, the outlook for lower inflation, but also because relatively high yields, real and nominal, have attracted inflows. Now, where does that leave us? Well, we are still concerned that emerging market assets face downside risks in 2015, not least related to outbound capital flows and lower commodity prices. But we remain positive towards domestic bonds in a subgroup that I will give the easy-to-remember name non-commodity exporting, more advanced Asia-Pacific economies. Moving on, let's look at the data. So as I mentioned earlier, we have seen currencies fall. This is not strictly speaking correct. Yes, most currencies in the region have fallen vis-a-vis the US dollar since July 2014. It is not surprising to find that the Hong Kong dollar and the RMB have fallen less than others. The RMB is, of course, fairly tightly pegged to the US dollar, and of course the Hong Kong dollar is pegged to the US dollar, full stop. But we've seen some quite substantial falls, notably when it comes to the ringgit and the Australian dollar, which has fallen almost as much as the euro, in spite of the fact that the Eurozone has had a few other issues that would put downward pressure on its currency. However, interestingly enough, if we look instead on the nominal effective exchange rate basis, which over the kind of short period we're talking about here is probably as relevant as real effective exchange rate and more up to date, we find that actually the only currencies that have really weakened in this way are again the ringgit and the Australian dollar. And in fact, I have just spent 2 weeks traveling in the Asia-Pacific region. One of the issues that came up constantly was the question of currency wars. If there is one country that definitely is engaged in currency war, I would say it's Australia. We had a drastic illustration of that today when the Reserve Bank once again cautioned that the Aussie dollar is far too strong, in spite of the fact that it has just dropped below 76 US cents per Aussie dollar, the lowest reading since the Great Recession began in 2008. Now, one of the things that I think is apparent from the chart you have on your screen, which shows the nominal effective exchange rate changes, is that in contrast to many other regions, the Asia-Pacific region is far from homogeneous. We have a number of different country groups. We have commodity exporters, Indonesia, though less than it used to be, Malaysia, Australia. We have commodity importing low to middle income countries, Taiwan, Hong Kong, for instance. We have advanced industrialized economies, Singapore definitely, probably Australia as well as it happens. And of course we have China. And as a group, as a regional group, the countries differ far more than, say, an equivalent Latin American grouping or European grouping would. And so perhaps it stands to reason that the impact of economic developments globally would differ substantially from country to country. I apologize, this pause comes because for some reason that chart was not supposed to be in there. Let me therefore go on. This is the chart you were supposed to have. I mentioned earlier that one of our forecasts was that share prices would fall as capital, or a downside risk to our forecast was that share prices would fall as capital sought either a safe haven or more attractive havens elsewhere. That, broadly speaking, is also what has happened in the region. Again, the percent change in stock market indices, specifically looking at the MSCI dollar indices since July last year, show falls ranging from a couple of percentage points in Hong Kong and Thailand to between 15 and 20% in countries like Korea, Australia, and Malaysia. The only countries where so far we have seen share prices rise over the period are China, where one could argue that the authorities can very much control what's happening to equity prices, and the Philippines. And the Philippines should not come as a surprise. My colleague, the somewhat confusingly named Gabriel Stern, made the point in an earlier research briefing for our clients that the Philippines is actually one of the countries that will benefit the most among emerging markets from lower oil prices. So higher share prices are probably what we should expect. Now, broadly speaking, what we have seen is, as perhaps not unexpected, that the share price falls have been greater in countries that have also seen the largest currency falls vis-à-vis the dollar. However, we now come to what, borrowing from Alan Greenspan, I would refer to as a conundrum. Bond prices should also have fallen if this was purely an issue of capital outflows, and bond yields should have risen. And in fact, what we can see is that bond yields have fallen quite sharply, again, varying, of course, from country to country. Taiwanese, Malaysian bond yields have, on the whole, changed very little since July last year. By contrast, Australian, Indonesian bond yields are down by 100 basis points, and the yield on 10-year government bonds from China is down by 150 basis points. Forgive me. What is behind this? Well, there are a number of potential reasons why bonds would have gained over the past 7 or 8 months. One of them is the outlook for lower inflation. Lower oil prices globally are pushing down inflation. The countries in the region are, broadly speaking, I mentioned Australia, of course, as an exception, but broadly speaking, these are no longer commodity exporting nations. That means they will benefit from lower oil prices, both in terms of a boost to real incomes, but above all, headline inflation will come down. And with the exceptions of Indonesia, the grey line here, and Hong Kong, the blue line, inflation at the start of 2015 was generally quite a bit lower than in mid-2014, not just, of course, in the Asia-Pacific region, but globally as well. Now, that would, of course, be good news for bonds, particularly if markets expect that inflation will fall further. Another reason why bonds would have done well is because bond yields have in fact been and remain higher than in many other financially more advanced economies in the world. So bond yields are attractive. To take but one example, Australian 10-year government bonds yield about 250 basis points nominal. In real terms, it's close to 100 basis points. The 10-year US Treasury yields slightly more than 200 basis points with underlying inflation at about 1.6. Bunds yield, well, about 25 basis points right now, and with the ECB and the national central banks in the Eurozone continuing to buy, the yield is going to drop even further. So there's quite a decent return on bonds in the region. It should also be noticed that, in general, current accounts have improved in the region. Forgive me. This means either if current account deficits have narrowed or if current account surpluses have widened, that domestic savings have risen relative to domestic investment. So there are funds that have to go somewhere, and bonds seem more attractive than equities. Excluding Malaysia, domestic savings still quite high in the region. And again, as I said, bonds clearly seemed to be the obvious choice. In addition to that, the impression we get is that foreign investors have actually not really left the region. There still seem to be capital inflows into some of the countries, which would presumably, again, be more likely to go into bonds, since we can assume that for the moment, Japanese, Eurozone or US equities seem more attractive. Finally, it should be noted that monetary policy continues to remain loose in the region and is likely to ease further. Again, we have this illustrated today when the Bank of Thailand somewhat surprisingly cut interest rates. The Reserve Bank of Australia is certainly likely to cut again. The Bank Indonesia has cut interest rates. We first thought that the impact of lower oil prices would simply be that they did not raise interest rates. They've since cut them. Bank of Korea cut, and likely to be followed by more countries. The only one where we are fairly uncertain is the Central Bank of China, that is the Taiwanese Central Bank, which is more likely to follow the United States. They may therefore raise interest rates. On the other hand, the other Chinese central bank, the People's Bank of China, has already cut interest rates twice in the past 3 months, is likely to cut them again, is likely to lower the reserve requirement ratio further, and is likely to widen the band in which the RMB may fluctuate, all of which should make Chinese bonds, insofar as the market is there, attractive. So where does that really leave us after this quick tour d'horizon of Asia-Pac asset prices? Well, currency is weak, likely to weaken. Equity prices can, for the moment, not compete with the greater attractions of primarily Eurozone and Japan, but also United States. However, bonds, particularly, as I said, if you are in that select group, non-commodity exporting, somewhat more advanced economy in the Asia-Pacific region, seem quite attractive, and it might be worth being overweight in those in 2015. I promised that I would speak for 20 minutes, and I noticed that I've spoken for 15 minutes. This should be a great pleasure to anyone listening, because I'm finished now, and I would be very happy to take any questions, which I hope Claire would have received in the meantime.
Thank you very much, Gabriel. We do have a couple of questions coming in, and please, if you do have any others, click on the drop-down menu and send them in. First of all, someone has asked, at the end you talked about exchange rates and exchange rates being quite weak. Isn't that more important than the attractiveness of bonds for investors?
Yes, of course it is. It's all very well to say that, for instance, in the case of Australia, if we stay with the most militant currency warriors, it's all very well to say, yeah, you can get 100 basis points real on 10-year Australian bonds, but if the RBA, meanwhile, is busy trying to drive the Aussie into the ground, you clearly have to make a choice there. All I can say is this is a matter of judgment. Obviously, hedging has its costs as well. Insofar as there are any currencies in the region that might hold up against the dollar, I suppose that would be primarily the Hong Kong dollar, obviously, because of its peg. Potentially also the RMB, because while in our view the Chinese authorities are going to try to avoid seeing the RMB appreciate together with the dollar against neighboring currencies, there's probably a limit to how much they will try to engineer a depreciation. Of course, that runs into the fact that Chinese markets are not quite as open as the others. So the short answer is yes, this is a judgment call that you have to make, and it does decrease the attraction of bonds, that's true.
Okay, and as a follow-up question to that, I'd like to add, what do you think would have to change or happen now that would change your view about the attractiveness of bonds?
That's difficult to say. One would, of course, be if oil prices stopped falling and started to rise. In fact, you don't even need them to start to rise. If oil prices stop falling, obviously the base effect on inflation will dissipate, over the course of 12 months. But the truth is, oil prices have been fairly flat for the past 6 weeks or so. So it's not even 12 months, it's 10.5 months to go and so on. That would have one impact. And the fact that you have some countries that actually do have rather high inflation rates by current global standards. Again, I refer specifically to Hong Kong and Indonesia, to some extent also the Philippines. That could quickly reassert itself. The other thing would be, I suppose, if we saw an imminent bull market in bonds, at which stage one would suddenly say, okay, this has gone far enough. I think a more likely development is if commodity prices stop falling and start picking up again. I should say that our base forecast is that commodity prices will remain flat over the next year, but that in itself means that the base effect will start disappearing.
As you mentioned that inflation is higher in the region than elsewhere. Couldn't that explain why bond yields are higher? What's happening to real bond yields?
No, it does. It is clear that this is one reason why bond yields are higher. But even bearing that into account, real bond yields still seem reasonably attractive by global standards. So I mentioned the Australian ones, but that's not the only country. In general, I think Korean. I shouldn't say anything because I'm not 100% sure if I start mixing up my numbers now. But broadly speaking, real bond yields still look more attractive than, say, in the Eurozone, let alone in Japan. Of course, if we start seeing a retreat in treasuries, or rather the retreat in treasuries continue, then at one stage US bond yields will become attractive too.
Thank you. And we've had one question which opens up the discussion a little bit. How dangerous would a 40% decline in Chinese real estate prices be for the region? Can the authorities mitigate it? And will it severely impact investment?
Well, 40%. That would be a substantial blow. Can the authorities mitigate it? Well, it depends a little bit what you mean by mitigating. Would they go in and support real estate prices by buying housing? I think that would be extremely unlikely. If, on the other hand, the question is, would the authorities go in and bail out banks that would be hit by non-performing loans as a result of this? Forgive me. The answer is yes, almost certainly. We have already seen that the Chinese authorities are going to bail out banks. If we go back to January of last year, when we saw the credit equals gold #1 wealth management product fail, and it was bailed out by an anonymous benefactor who we now know was far wrong, one of the government's set up bad banks. So the authorities will do what they can to mitigate. They have seen in the rest of the world what happens when you don't. But it would certainly be a blow. It would certainly cause a sharp slowdown certainly in Chinese real estate investment. There would be spillage to the rest of the region, notably via countries like Hong Kong, Taiwan and Korea, which have the closest banking links with China. It's difficult to quantify, but absent any major mistakes on behalf of the Chinese authorities, we are talking about a slowdown in growth, perhaps a sharp slowdown, perhaps potentially even a Chinese recession. But we're not talking about a repeat of 2008 here. This will be a localized impact. There will be a period of weakness, but it will be, as it were, a more normal cycle. We're not going to head back into a global recession, let alone a depression. I'm sorry, I can't quantify more than that because and we could do it using our model, of course, and it's part of what we are looking at for our downside scenarios. But right now, all I will say is, as I said, it would be bad, but it's no depression.
I could refer to people who are interested in that and looking at our global scenario service, where we've looked at what the effect would be of no growth in investment for a year on China.
Thank you.
So we have covered that. I have one final question. You talk about capital flows a lot when you're looking at asset prices, and by extension the behaviour of foreign investors. Mm-hmm. So what about the behaviour of domestic investors?
Actually, that's a really interesting question because, and thank you whoever asked that, because very often when we look at these things, we tend to concentrate exclusively on capital flows by which we tend to mean exclusively foreign investors. Well, of course, capital flows are driven by domestic investors too. In almost any financially advanced economy, and frankly all these countries, with a possible exception, I suppose, of the Philippines, are pretty much financially advanced. Domestic investors are far more important than foreign investors. But on the other hand, if you have free capital movement, it also means that capital flows in and outbound can be determined by domestic investors. It's safe to say, I think, that in general, domestic investors in every country tend to have, as a group, a home bias. And I think part of that is actually the reason why we're seeing bond markets do well. As I mentioned earlier, domestic investors, these are still countries where there's pretty substantial savings rates. Money has to go somewhere, and if you invest domestically right now, bonds seem more attractive than shares. As against that, of course, at one stage, domestic investors can also leave. But yes, domestic investors are, well, foreign investors are probably crucial for the margin, but overall, on average, domestic investors are more important. There's no question about that. And they would probably look around and say, our cost base is in pesos or ringgit or rupiah or whatever. We could perhaps make more money if our currency is falling, but as against that, we have to match certain assets and liabilities and so on. So I think their behavior is crucial and something that analysts all too frequently tend to ignore.
Great. Thank you very much, Gabriel.
Well, thank you, and thank you everyone who was listening.
Thank you all very much for attending. If you'd like any further information about Oxford Economics, please feel free to get in contact or visit our website. The recording and the slides will be sent out later today for all those who are registered. Thank you, and have a good day.